Sandip Sabharwal joins us now, and he's just been traveling. He's been on holiday, and he's back. How was holiday?
All good.
And he's been watching some great tennis as well, I guess, Nikunj.
Yep. Djokovic,
Yeah.
24 Grand Slams.
Yeah, absolutely. He has absolutely created history now.
You know,
Tremendous.
only thing where highs are made, Sandeep. One is for Djokovic in tennis, and for Indian markets when it comes to the numbers.
Yeah, so let's see if there's a correlation.
Absolutely amazing. I mean, just when we thought that after the last Wimbledon that Djokovic had reached the prime of his career, he comes back, and he comes back decisively. I missed the match last evening, so I did not catch up the match. But yeah, I mean, I was waiting for the cricket rather than tennis. And then what happened in cricket, we all know that. But yeah, I mean, Djokovic, hats off to the man. I mean, he is a legend.
Yeah,
Master of his
It
craft.
was at an unearthly hour also, but it was crazy because I believe he cruised to a very easy win in the first set, and then he claimed 6-3. And there was it was quite a tough fight. Tried to stage a comeback, but there you go. It was him, really clinching that title.
Okay, Sandeep, what's been keeping you busy apart from enjoying a break from the markets and from meeting our studio?
So I think markets have been interesting in the sense that we've seen again a sort of break in correlation of Indian markets with the global markets, which happens, but it does not sustain. So I think that's something we need to watch out for. The result season went and came and went, and I think to that extent, all of that got factored in. Now, there are some concerns related to valuation, what the impact of monsoon not being as good, etc., will be there. But overall, I think my base case view always was that October, November will be the time when we should see some sort of correction in the market, which should happen because the rise in the midcap indices has been quite euphoric, and typically that has to be followed by some sort of correction. So I think to that extent, people who are buying speculative stocks at this stage should be a bit careful. But I don't see a very deep sell-off in the sense that it's not going to be 10-15% kind of correction. So I think a moderate correction, which will give opportunities to buy. Overall equity outlook, I think, is still constructive.
Sandeep, did you watch the G20 Spectacle in terms of that, quite the feather in the cap for India being such a host for this time around, and especially the mega economic corridor, Sandeep, which gets opened? Just wanted to understand the market implications because these sectors already are the hot ones in the market, right? Be it data, railways, electricity, renewable energy. Do you see a significant more move, at least when it comes to the railway stocks?
So, Nali, what's going to happen? Aisha. So, what's going to happen is that these are very long-term initiatives, and it requires a lot of agreement between different countries. So, there is a shipping corridor, then there's railways, which goes to several countries, etc. So, it's very long gestation. It will take 8-10 years at least to come through. So, to that extent, buying those stocks now in the expectation of that will happen might not be such a great idea, especially when many of these stocks have run up so fast. On the biofuels front, the initiatives might happen faster because it's more country specific. So specific countries will implement their mandates, etc., which have already been there for some time. So to that extent, there the movements might be faster.
So what have you bought or sold in last 15 days?
So we've been adding on to our old holdings in Prague Industries because I think the outlook's improved with their foray into compressed biogas segment now becoming more clearer and visibility of growth being there from that. And the Biofuels Alliance might help them. Their Panipat plant, which works on agri residue, that's which the IOC had set up. I think there the production levels have gone up substantially. I think there are several positives going for them. So that's although the stock has moved up, but I think it still holds potential. The valuations got held back because people thought, what after ethanol? and now there's clarity of what can happen after 1G and all. Second, we've been also accumulating voltage because I think that's one stock in the mid-cap side where it's still reasonably placed. It's 30-35% of the top. People became negative because of poor summer sales of AC, but on that front, results are okay. Their projects business order book has ramped up substantially, and I think that's where a lot of growth might come through. I think that's where one stock I see value. And we have also accumulated Aditya Villa Retail at slightly lower levels because I think all negatives are in run up to the festival season. We could see a revival. So that stock went to 350, 360, fell to 200. So I think around 210 levels, it looks reasonable for the long term.
Wanted to get in your take. Lots of news reports and no confirmations as yet with respect to the Cipla acquisition, the likes of Torrent Power, PE players, Dr. Reddy's in the fray now. What do you believe it could potentially mean?
So I think from a buyer's perspective, it will require a huge amount of cash drain for a company which is not exactly available at cheap valuation. So I think if any listed player in India decides to go ahead with the acquisition, it could be negative for their stock prices in the near term, for sure. If obviously a private equity buys, then it has no implication on any listed company, but then it has positive implications overall for the Indian economy, as huge amount of potential FDI could come in. And if a private equity buys into Cipla and takes a majority at these valuations, that also gives confidence on the how they see the future growth outlook of the industry overall.
Cipla at 1244, the stock has done rather well for itself in this year. Well, there's an interesting denial which has come by a policy bazaar or PB Fintech. On based of a media report, they've reacted and informed the exchanges that no, we are not moving into insurance manufacturing. Now, PB Fintech moves into insurance manufacturing. You would ask yourself, bhai, kya kar rahe ho? You're a distributor. Why would you go into insurance manufacturing, which is a business which is completely dominated by different dynamics? You make a lot of loss, you require a lot of capital, and it's extremely, if I may use the word extremely again, competitive market. But insurance per se, Sandip has made a comeback, especially health insurance. I was looking at data for non-life, I think last week, for Star Health, even for ICICI Lombard. The non-life business now is making a comeback after that twist and turn what happened during COVID.
Yeah, so Nikul, if you see the overall business is not growing, but LIC is losing market share rapidly, and that's helping the private players. But that's fine for the shareholders of the private entities. And in the overall insurance pie, now the growth has been erratic. Like in some months, the growth has been very strong. In other months, they have been subdued. So I would think that it's a sector which is reasonably placed, but just on valuation of most of these companies, I don't see any big upside in the near term.
Couple of other stocks which are going to be in focus, and we've already talked about the ICRR impact on banks. Having said that, you did not really see a very meaty move on banks in Friday's session. Yes, they spiked up to the day's highs, but cooled off a little bit from there as well. But Kunal, from last week, HDFC Bank has really come to the fore. Do you think leadership will remain with either HDFC Bank or some of these large private banking names?
So interestingly, the leadership in terms of the price performance has come back into few large cap names, not all of those large cap stocks. For example, if we look at a relative scale, now HDFC Bank is nearing its previous swing high breakout, which was around the 1650 odd mark for the stock price. So it's nearing that by a margin of say 1%, 1.5%. You try and compare this with the other private sector banking names, like for example, IndusInd Bank has actually given a breakout of that 2 month, 3 month of consolidation. Axis Bank is again a couple of percentage points away from breaking that 995 mark, which is the previous high for itself. Kotak Bank is significantly off. So it's very few large cap names which have participated. The only refreshing part for HDFC Bank was that the stock has seen a lot of dramatic change in the open interest positioning. And I think that could be one of the key reasons why you may expect a strong momentum on the upside for HDFC Bank. formations of RSI divergence on the daily time frame, which is not being seen for the likes of Kotak, Axis, etc. So that is the distinguishing factor for HDFC Bank, which I believe could lead into a decent rally for the stock. So would be bullish on few of these private sector names as of now, because the evidence is just restricted towards very few stocks within the space.
Sandeep, is private banking, the large 2-3 names, more like a no-brainer trade now? They're cheap, they've not participated, nothing is wrong. Underlying bullishness of the economy is going to only help them. Is Kotak Mahindra Bank and HDFC Bank more like a must-have or go-to trade immediately?
HDFC Bank has underperformed after having a run-up post the merger approval. Now, in the near term, it should do reasonably well, given that ICRR uncertainty has been reduced. Now we need to see the actual impact of the merger on the margins over the next 1 or 2 quarters to finally say that what kind of mojo it can retain and come back with. Axis Bank, ICICI Bank, I would think are better placed because they don't have that those merger issues to deal with. So in the near term, because HDFC Bank underperformed so much, we could see some outperformance. But longer term, I would prefer Axis or ICICI. Kotak, despite the severe underperformance, still is much more expensive than all the other banks.
Right. In fact, talking about some stocks, let's hear it out from Sanjeev Bhasin as well. He's actually betting big on LTI Mindtree. And also Nishal Maheshwari. He likes PNC, HG Infra and Triveni Engineering as well.
The best play, which is going to be star as far as the AI circle goes, and which is seeing huge amount of order inflows and high margins. Their attrition has been the lowest, and I think LTIM is one large cap which I can now bet on because it's on the index. So like I said, I'm focusing on large caps in the index. LTIM, Reliance, ICICI Bank, Axis, and if we are going to see Bank Nifty expire above 45,000, then both these large caps have to join. But LTIM is my stock for this from here till Diwali. 6,000 plus is coming on LTIM by this Diwali.
Other stocks which we like is PNC and HG Infra. So that is the stocks which we like basically as far as construction is concerned. But overall, if you look at on the capex side or the capital goods side, then I think there are some good stocks basically even in the smaller category. Triveni Turbine we continue to like basically, and then Apar Industries is what we like. So there has been quite a few smaller ones also which still continues to be fairly priced, not very aggressively priced. So these are the stocks basically which we like in the capital goods sector. Yes, the order books have been very strong.
Five crore shares of HDFC Bank, they've exchanged hands, and this is in the pre-market FI window. And this is the one stock which has done very, very, very well for itself. Yes, I said IDFC, right? What did I say? Okay. IDFC First Bank, and that is where IDBI I must have said. Slip of tongue, beg your pardon. IDFC First Bank, 95 rupees. The stock has done rather well for itself in terms of standing out from a mid-cap space. Sandeep, now the market always tends to, and especially when it comes to addressing our viewers here, they are always looking at high beta names, mid-cap banking names, stocks which are cheap and stocks which could participate. Where do you think there is margin of safety and enough earnings visibility in the mid-cap banking space?
So I think in terms of the overall financial space, actually, I don't buy smaller banks because having looked at previous cycles, I know that they eventually come back to revert back to mean and below. So I'm not a great advocate because I think mainly because of the fact that they always run into NPA issues, and secondly, on the cost of funds front, in a tightening interest rate cycle, they always are at a disadvantage. So I would not be the right person to ask this question actually.
95 and a half. It's done phenomenally well for itself. There are two more stocks which are worth revisiting, Naresh, and that is PFC and REC. They are on some kind of an epic bull run. Are they looking good to go for more, or these stocks are now too late where you should not, you should simply avoid them? I mean, you missed it too bad, but don't jump in now.
Absolutely. So I thought at 270 odd levels, PFC made a top. We saw a correction on the MSCI rejig also, and in 2 days it has recovered from 260 all the way to 305. So overdone, thought it at 270, thought it at 305 also. So it becomes a difficult call here because the risk reward is not great at current prices. So if somebody is looking to buy at current levels, the risk reward is not great. Somebody is holding on, could maybe give a revised trading stop loss at 275.
Okay. PFC and REC, these are two stocks which in a sense, and by the way, they still have a good dividend yield. I mean, who would have thought that of all the names, PFC and REC, which have a predictable model, very clear defined in terms of return on NIMs, the cost of borrowing, nothing changes in terms of the business model, but stocks are up more than 100%. And I'm talking about this year, the couple of months are still left. Sandip, if you, let's say, had exposure to railway stocks or power stocks, or for that matter, any PSU stock, would you ride the momentum for next 2 or 3 years, or you would say that it's too late now for me to buy fresh, but I would like to get the, I would like to now move out?
So it will depend sector to sector. For example, if someone thinks that many of the OMCs look cheap because they have not participated so much, and then you have to realize that till the next election, you're not going to get any fuel price changes, so they might actually go into losses. Similarly, I think there's no gold at the end of the rainbow for REC, PFC, and all these companies, like you are rightly saying. Nothing much has changed for them. It's just that there is some euphoria in the PSU stocks. So can it last? Like, since the overall equity view for the next 2 years is still constructive, it could last, but this kind of outperformance might not sustain. So my view would be that whoever is holding, there is no big incentive to actually sell. There might be corrections, but then the stock prices might sustain. But whoever is looking for fresh entry, I think the valuations have got extended, and you might be able to get it cheaper whenever the market corrects.
Kochi Shipyard, Muscat Shipyard. Well, I can throw in even Garden Reach. This entire shipbuilding space has been the prime mover in last couple of days. Cochin Shipyard up 126%. For PSU stocks, 100% is normal this year, is it?
Yeah.
Yeah, every stock is up 100%. I mean, you take PSU banks aside, but in general, 80 to 100% is the new normal. If you've gone up less than 100%, if you're a PSU stock, you've underperformed. You've underperformed.
Which means you've underperformed. Yes, and I think the defense stocks, particularly the shipyard names, in the last 1 month, they've risen up 50%. I think more than 50% in just last 1 month. August mid somewhere, GRSE was around 600. And the stock, I think, on Thursday hit a level of 960 or 980 for itself. And so is the case with Muscat or Cochin Shipyard has been on upper circuit, I think, the last couple of days. So phenomenal uptrend for these stocks.
Sandeep, I just think about this year, and it's just been a year where you've seen extraordinary volatility, fantastic returns, and unbelievable moves. Extraordinary volatility in Adani group of stocks. Extraordinary. Came cracking down, recovered, and now they've stabilized. You've seen an unusual move perhaps in some of the railways and in some of the defense stocks. And you've seen a great comeback in IT. At the beginning of the year, nobody expected this kind of a price hike. I mean, you may go up by 15%, 20%, that's understood. But 80 to 100% is the average gain for the PSU non-banking space this year.
Yeah, so I think that's why markets are what they are, and they tend to surprise us. So there have been such a wide variety of stocks that have gone up. So there's no use regretting what you bought or what you did not buy. So like contrarian buys, I remember contrarian buys which we did in Lupin, Bharat Forge, etc. when they were not doing well. All those stocks, like Lupin is up some 65, 70%. Bharat Forge is up 50, 60%. So I think you need to play you need to actually look at stock which you would actually have bought. So for me, for example, I would never have bought too many PSUs. So if I never would have bought too many PSUs, there's no need for me to regret looking at how those stocks have moved because that's the investment strategy.
Okay. 14 points down for SGX Nifty, and for Nifty futures, well, as you could see that there is no large price trend. So Naresh, how would you approach railways, defense and shipping stocks this week?
The approach is to not approach them right now. The risk reward is way off, and it's difficult to be trading at such say volatility also. So for now, look at the other side of PSU, something like oil and gas. That is where I would be more interested. So we are seeing a good breakout in ONGC and Oil India, and even in IOC saw volumes. Even a power grid is coming close to a 52-week high. So there are a lot of defensive plays left in the PSU side, which could look more interesting.
Infosys, let's see what that stock would open at. And Sandeep, Citi has come out with a note on a management meet and still very blow hot, blow cold kind of commentary. While they've talked about large deal ramp-ups are going to aid their growth, they've also said softness in short cycle deals continues. We all know about the sizable large deals that have come in, but again, not really categorically telling you whether the near term is looking rosy or at least the worst is behind us.
I say it's impossible to decipher the commentary which these large cap IT companies give. Like they just talk in such language that you just cannot interpret what's going to happen. So you need to take your own calls. I think on the IT spending front, given where the interest rates are in the US today, they will definitely be cut down in discretionary spending, slow down, people will be cautious, etc. So IT performance this year has been so disparate. Large caps have done nothing, while on the mid cap side, there have been such tremendous performances. So even there now, many of the mid cap IT companies are trading at valuations higher than the larger cap ones. So whether that will sustain or not, we'll see. So I would think that we should still be cautious on IT overall.
2 minutes to go, and then we'll get the pre-open rates. Not that anything exciting is there in terms of the pre-open session. You will see impact on a Prague, you will see impact on some of the railway stocks, you will see impact on some of the ethanol and biofuel companies. But remember, these are things which will not fructify or anything will happen in next 2-3 quarters. These are long cycle, big policy impact. I mean, it's like China plus one when it started at peak of COVID. Now you see evidence of that. The whole outsourcing story in manufacturing started from COVID, and it is now seeing evidence. But also, you got to realize that a stock like Prague, or for that matter Gulshan, or any of the sugar companies, they've already seen some extraordinary run-ups. So biofuel, I think, is need of the hour. It is something which is, which is all about climate change, carbon emission reduction. But from a market standpoint, if these stocks they go higher in the short term, I think it is something where you got to ask yourself: is that are some of these stocks trying to run before they can walk? Because the run-up in some of these stocks again has been by far extraordinary. Another pocket, Naresh, where the gain has been extraordinary is the entire electronic manufacturing space. You got a Keynes to and Sirma SGX, or you got price action in a Dixon and Amber.
So out there, say the newer ones always do better. That has been the case. So Dixon, for example, has done well in the short term, but is still lower than the highs made in 2021. But Sirma SGS has gone up from 280 odd levels to 580. The case here is the trend is still positive, and they've not seen a very violent move. So it has been a slow and steady uptick all through the last 4 to 6 months. Overheated, so not expecting a deeper correction, but a time-wise correction could be normal. So out here, a 10-15% fall from the top would be normal in, say, a couple of months of sideways action rather than a big drop. So out here, yes, the trend has been strong. There is a lot of, talk about the sector. There have been 3 to 4 initiation coverages across the broking outfits, and that after a 50% run-up. So overall, the viewers expect a pause, not maybe a sharper correction.
Okay, the pre-open rates then this morning, and let's just revisit what the Nifty is at and whether or not you're seeing a move ahead. And an attempt to that 19,900 mark should happen. Yes, it is 19,930 on the Nifty futures and climbing even further as we speak. Couple of positive ones, and HDFC Bank analysts are saying that the merged NII is going to get impacted by 2% on account of ICRR removal in a phased manner. So let's see what HDFC Bank is up to, because this is also, remember, going to contribute a large bit to the Nifty move up as well. 1% higher for HDFC Bank as we speak. The Tata Group and maybe Tata Elxsi, though we don't know which company this is going to be digested in, but they're looking at a tie-up with Nvidia, and the announcement came by over the weekend. Tata Elxsi has jumped up about 1.25% as we speak right now. For our IRB Infra, the toll collections have been very strong in the month of August, an uptick of 24% on a year-on-year basis. There's CAMS as well, which is expecting a 15% AUM growth and 12% revenue growth in the RTA business, so look out for that. And how can we not talk about the railway stocks? They've really been the darling of the market, and now with the India-Middle East-Europe rail and port connectivity corridor, which got announced in G20, most of these stocks will see a big move coming in. IRCTC, IRCON, IRFC, these are all stocks which are seeing some mammoth moves coming in. Also Praj Industries, look at IRCON, that's almost a 10% move that you're seeing on this particular stock alone. Praj Industries, that's going to be the other one, and a 6% gap up there. We'll be chatting with the management as well shortly on the show. The Global Biofuel Alliance, which got launched on the sidelines of the G20 summit. In fact, we'll try and understand with the management as to how this really spells into business for Praj Industries. Shishir Joshipura will be joining in at 9:40 a.m. to talk about exactly that. We're going to be chatting with the management of RVNL too. And I can't really get my eyes off from what the railway stocks are up to. RVNL should come up for you on your screens, but the big mover is going to be IRCON, not IRFC as much, but IRCON, which has now gapped up about almost 10% as we speak right now. There you go, that's a big move on the stock. JSW Energy as well, wherein reports are indicating that TPG, Brookfield are all in talks for a JSW Neo stake, which is eyeing about almost $500 million odd. That's JSW Energy, not much of a mover there in trade. But let's get some mid-cap strategies going, Kunal. That's where all the action also seems to be, while the Nifty is also chugging along to that 20K mark. What's on your mid-cap radar?
So there'll be a buy on CESC, a stock which I think again from the power names has managed to give a slight edge of breakout towards the short-term charts on the daily time frame, about the 90 levels. 92, 93 is where the stock closed on Friday. Momentum coming back into the stock. Volumes are also exceptionally strong for the stock in this last 2-3 days of up move for CESC. So would suggest a buy with another 10% at least on the target on the upside, 104 as a target, and stop us at 87.
Okay, let's find out what Naresh is picking out as his top mid-cap call. Naresh?
So that would be a buy on LIC Housing Finance. Maintain the bullish stance on the stock. The stock gave a breakout above the 440 odd levels, which was high for the last 2 years. And after making a breakout, the stock is consolidating around the 450-55 mark. A flag formation here would expect a next move towards 500. Stop loss at 430.
All right, there you have it. CESC and LIC Housing are the stocks that our chartists are picking out.